During the third week of April, Federal Reserve Chairman Jerome Powell gave a speech in which he invoked the name of Paul Volcker and he implied that a 75 basis point hike was not off the table. He has since walked back some of those comments, but some interesting things happened in markets in the comments' wake. On April 22nd, the 5-year break-even rate had a huge reversal day where it traded from a high of 3.67 to a low of 3.36, and then continued lower in the following 18 days to a low of 2.94 on May 10th, which is the day before a critical CPI number. During that time, the yield on the 5-year U.S. Treasury has only traded marginally lower from 2.97% to a current 2.90%. The break-even rate is commonly used as a predictor of future inflation. Now, some analysts seem to believe that the chairman's resolve may be sufficient in cooling the current round of inflation. Of course, the S&P 500 also began a sharp move lower on April 22nd that had it down 11% in 2 weeks. So possibly the 5-year U.S. Treasury yield and the break-even rate are only reflecting the deflationary pressures of a declining stock market. Now, if a trader believes that the break-even rate is signaling less inflation concerns going forward and that long-end yields may fall as a result, they could express that by selling the micro May 5-year Treasury yield futures contract at a current level of 2.93 and target the April 13th lows of 2.70. A stop for this trade could be placed above at 3.10. This trade could make $230 if your target is reached and risks $170 if you're stopped out of your level. Now, if a trader believes that the 5-year U.S. Treasury yields are heading higher, perhaps with a resurgence of inflationary concerns, they could express that by buying the micro May 5-year Treasury yield futures contract at 2.93 and target a trendline extension level of 3.25 above. A stop for this trade could be placed below at 2.73. This trade could make $320 if your target is reached and risks $200 if you're stopped out at your level.